Well, hello and good afternoon, everyone. I'd like to welcome all of you to today's special guest webinar, an end of the year update on banking perspectives and M&A financing. My name is Brent Holliday. I'm the marketing manager for Capstone, and I'm going to turn it over to our host very shortly. But since we are offering the option of CPE credit today for our attendees for this presentation, I am required to do a little bit of a disclaimer. Capstone is registered with the National Association of State Boards of Accountancy, or NASBA as they are known, as a sponsor of continuing professional education on the National Registry of CPE sponsors. State Boards of Accountancy have final authority on the acceptance of individual courses. If you have complaints regarding any individual sponsors, you may submit those to the National Registry website at www.nasbaregistry.org. And for those who do wish to receive CPE credit today, our host, David Braun, is going to ask 3 questions of the audience over the course of the presentation. Now, all you have to do is type your response into the question box feature that you will see on your GoToWebinar dashboard. This is, while there is no right or wrong answer to today's question, NASBA does require that you answer all 3 poll questions in order to earn your CPE credit certificate. This is also the same feature if you would like to ask a question of either of our presenters today. You can just type that right into your question box, and we will do our very best to get that over to them and get that question answered for you. And now, since no one came to hear me speak specifically, I'm going to turn things over to our host. He's a recognized thought leader in the field of M&A. He's the author of the book Successful Acquisitions, and he is the founder and the CEO of Capstone Strategic. I'm going to turn the floor over to Mr. David Braun.
Well, thank you, Brent, and welcome everyone. Delighted to have this special webinar. I think it's a very timely conversation, and I'm absolutely super excited that, Aaron, you're able to join us today. Let me give a little bit of background, and then I'm going to introduce Aaron. But in this rising interest rate environment, it's not that we haven't had interest rates rise in the past, but I don't know of a period of time where they've risen this quickly. Maybe there is, but I'm not, certainly not in my recollection. I don't recall one where it happened so fast. And so for many of you that are listening today, we wanted to put together this conversation to really give some perspective on what's happening right now as it relates to M&A and bank financing. And for the genesis of this was we had a lot of our clients that were asking us to have this conversation, and so we wanted to bring it to you. And so I'm delighted that Aaron's with us today. Aaron is a senior VP at Atlantic Union Bank, which is headquartered in Richmond. They're the largest regional bank in Virginia, I should say, with over $20 billion in assets. And I will just tell you at full disclosure, we've done work with Atlantic Union Bank for a number of years. We refer them and bring them in on our client engagements and think very highly of them. And that's why I was so excited about Aaron being able to join us today, because I think it's really important to get a direct perspective on what you see happening and be able to have that kind of conversation. So and as Brent mentioned, if you have questions, put them in the chat box for CPE credit. Those of you that want CPE credit, I will ask 3 questions, and then you just respond in the chat box, and that way we have a record that you're actually paying attention. So let me welcome Aaron. Aaron is a senior VP, as I mentioned, Atlantic Union Bank, hails from Pennsylvania, good Penn State grad, but also went west and went to ASU, Arizona State University, for his MBA. I've been in the banking world for a number of years. I won't mention the other banks because we don't want to give too much highlight to them today, Aaron. But again, delighted that you're with us, and let me turn it over to you and look forward to the conversation that we're going to have today. So welcome.
Yeah, well, thanks so much, David. Really appreciate the opportunity to be here and the introduction there, and certainly the testament to Atlantic Union as well. So very excited, happy to be here. And I think just kind of want to jump right in here in the interest of everybody's time. I think a bunch of good material, so just want to drive right in. I think, David, when you reached out, wanted to talk about M&A financing, I thought it really helps to set the backdrop to that with the year that we've gone through and what that looks like, and that really drives the conversation. So I do want to spend a couple minutes on that, just painting the picture that really drives where the financing market is. But then also the M&A update in particular, and then I think we'll spend most of the time on that senior lender perspective around M&A and where we are. A couple points on the path forward, and then obviously any questions anybody has, certainly happy to answer or give my thoughts on that. So year in review is a pretty interesting year in banking. I always have said to people, if banking's front page news, that's usually a little bit of a scary thing. And we were front page a couple times, not Atlantic Union, but the banking industry in general. So certainly some events on the banking front this year. I think the one at the top there here, I tried to break out some news clips that you've probably seen over the course of the year. And if you go back, if we were having this conversation 12 months ago, the headline, as people were making their outlook or predictions for 2023, so if we were sitting here December 2022, the outlook for this year, a lot of excitement, negative excitement, but excitement nonetheless around yield curves inverted, inflation's out of control. We're looking at an impending recession, and there's probably going to be rate cuts by summer. Now that obviously didn't come true. So as people like to do their year-end predictions for the next year, I always caveat that by saying predictions are often incorrect. But still, that did set the table for what the year might look like and how it shaped banks' appetites as well. I think as we got into the year, the big story obviously in March there was the signature bank, Silicon Valley Bank, First Republic. That really drove some scares and front page news on the banking industry. Thankfully, those were non-traditional banks, more on the fringe with non-diversified deposit bases. All traditional banks, very, very secure and really almost became a non-event, but it did attract a lot of interest and everybody took notice. So a lot of these things all play into one another. And as banks saw the economic backdrop a little not sure footing, you had the scare with Silicon Valley Bank, that really tempered some banks' appetites. So that was one of the storylines. In the face of that, we did have the inflation just kind of running pretty rampant there. So the Fed acted. So we did have, as David mentioned, that pretty aggressive rate hiking cycle. Coming out of that, the bank deposit there, I said the new capital requirements, that's in the news now. That'll continue to drive a little bit of the conversation. I think as some banks maybe wait to see how that plays out, if they're going to have to keep more capital in reserve. As coming some of that obviously around this, and David, you and your firm can obviously speak even more to this, but just a little bit of the slowdown on the M&A market is just slower volume, slower deal flow through the year as a result of some of this economic backdrop. More specifically, benchmark index, if people weren't following that, LIBOR, that was talked about going away for not quite a decade, but 5+ years. Extended multiple times. That finally did go away this summer. Bloomberg tried to have their alternative to LIBOR, BSBY. That was just announced last month, but that's going to be going away. So, SOFR is now the undisputed LIBOR benchmark index replacement. So that was some of the news this year. And then at the bottom there, almost full circle from where we were 12 months ago. So now we're seeing inflation start to ease. We had one tape read there recently that market kind of reacted with Jubilee, rate hike cycle over. We'll see about that, but just some of the news stories to paint the picture of where we've been. Jumping into a couple graphs here or charts here. If you look at that top chart there with the yield curves, and then I have SOFR overlaid over top of that, if you just looked at it without looking at any of the references there, you would think, oh, that just looks like a normal curve, but it's kind of almost funny that we're looking at that and it almost looks normalized, but it's inverted, and it's been inverted for so long that it's interesting that now I've put up over 12 months there, and it kind of looks stable at that rate. But it's never not interesting when the short-term money is a lot cheaper is more expensive than the long term. So we'll see where that goes, but that obviously, is unique to the last 18 months or so, and certainly not normalized in the long term. You can see in the bottom there, as you look back the last 25 years and really through economic theory of how you would picture longer duration versus shorter duration money there. So just like to paint that picture as well. It's certainly something that's always worth considering or thinking about in this backdrop. The top chart on this slide here, the inflation cycle. So you can see, very fast rise in inflation, but then also very fast decrease in inflation too. I think the one thing to highlight on that is, again, the read off of, it was the October number released in November that the market kind of jumped at as, hey, inflation's done, and we're done with rate hikes as well. The thing I would say is, if you look at the last handful of months there, it almost looks like we've plateaued a little bit, and I think we'll need to see, or the Fed will need to see, if that continued to truck down a little bit, and the lag in data to continue to pull through. They've stated multiple times that the 2% hurdle there is their target. I've got that darkened. So if they're really going to hold to that, and we end up plateauing at 3%, maybe there is another hike or something to keep moving it down. So we'll see. I think the market reacted pretty favorably to that last read, but as you can see, the last handful of months a little bit flat. Jumping into the bottom there, you can see this is a syndicated loan, non-sponsored money market, new money, and refinance issuance here, going back the last 20 years. And so you can see here recently this year, there has been a decline as you look to the right of that chart. Now, there's a little bit of a boom there. So if you take just kind of the recent numbers and you go back, yeah, it's a little bit light, a little bit soft, but not unreasonably so if you average out kind of that entire graph. But certainly something to look at, and people have their eyes open to, that there is a little bit of softness there, or at least decreasing trends. So that's really the backdrop that I wanted to paint of where we are and where the year has been. Obviously, there's noise. I think there's a lot of uncertainty that remains. A lot of the predictions from a year ago didn't play out, but those predictions still do sometimes influence banks' appetites and where they'll play and where they will lend. So getting into M&A update specifically, and David, obviously you and your team, speak more exclusively.
Hey, Aaron, let me interrupt for just a second, because this is a good time since you're going into the M&A update. Let's do a quick poll so that we're compliant for CPE. So those that need to have CPE credits, so the question is going to be, do you think that inflation is going to continue to decline? So Aaron was just talking about how it's kind of plateaued. Do you think it's going to continue to decline? Yes or no? And you can put that in the question box, not the chat box, but actually the question box. So if you look at the inflation cycle there that Aaron was just talking about, you can see where it's went down, but it's kind of went back up, it's come down a little bit. So it's just sort of flat lining there a little bit. I know the Fed is hoping it's going to continue to decline, but for those of you, again, for CPE credit, just answer yes or no. Are you thinking that inflation is going to continue to decline, or do you think it's going to, do you think it's going to continue to decline, yes or no? Aaron, back to you.
All right, awesome. Yeah, I'd be interested to see those results as well. So I certainly don't have the crystal ball on that. So
all of our crystal balls are pretty cloudy, I think.
Yeah, exactly. So as you look at that M&A market, though, you could see a little bit of a slowdown, softness there for sure. I think, David, I'm sure your team's hoping to see that pick back up. And I think, eventually it will. It's not going to indefinitely cool off. I think probably as you look back across a longer time, I think there's some reversion to the mean there and some normalization. So I don't think maybe it's as drastic as people think, but it definitely is a little bit soft over the course of the year for sure. So we'll see, if that hopefully levels off and then starts to climb back up. I think the interesting counterpoint to that, though, is that valuations have mostly held. They've bounced around a little bit, but there's still some strong valuations, and I think maybe that speaks to some of the disconnect sometimes that comes in between buyers and sellers of what that should be, and maybe that's playing into the deal volume a little bit. But in general, some of those valuations have held. You see what I've circled there, and where this conversation will obviously go is around the finance aspect and the leverage levels. And so while it's a slight movement, you can see it's a little bit of a consistent movement down in leverage level. So, if you go back a couple years there, 3.3, pushing that 3.5 times, and now we're pretty level at 3 here, going back over the last 6 months to even the course of the full year. So not a large movement, but a consistently slight movement to a more conservative leverage level. And what's playing into that, I think we'll get into that, but it's an interesting data point that I think what we talked about, the economic backdrop, plays into that. What I'll go into around some of the banking industry stuff as well plays into that, but it plays out in the data a little bit, and you can see it. What I've got circled is the senior debt where our bank plays, but even in the total debt, there's that slight decline as well. So just wanted to highlight and circle that.
Hey, Aaron, we had a question come in on that. It was kind of a clarifying question. So you're talking, the 3 is 3 times EBITDA, and is that trailing 12 months, and does that include adjustments or add backs?
Yeah, so great question. And so this is from GF data, which if you're familiar with ACG, that's where that comes in. So I don't want to speak to specifically if they're adding anything back to EBITDA, but it is the funded debt to EBITDA calculation, which most banks are going to consider as a leverage point. Each bank's probably going to have maybe a slightly different look on what they'd add back to have that adjusted EBITDA. Yeah, and then the trailing 12 months, or if they're taking an average of 3 years, slight differences. I don't want to, off the top of my head, I don't want to speak to the GF data parameters, though. Does that answer that?
You did.
Okay. So yeah, just continuing on. So a little bit less deal flow, but I think the important thing to note is that good deals are still getting done, and they have strong support for sure. So it's not that the markets have dried up. I think you're just seeing some people maybe on the sidelines. Back to that leverage level, I say slightly more conservative. What's driving that? That next bullet point down, I think it's interesting. There's less volume, so you would think banks would be competing more, but it's almost slightly less competitive from the senior lender standpoint. And I think that's driving some of the leverage levels, driving some of the structure. Our bank has tried to hold to our underwriting parameters, so I think that's the credit worthiness is, what we have is our policy. That's what we're doing in good times and in maybe more uncertain times, because it's that strong credit. I think we've seen, though, and we've heard in the market that some banks have been rationing some credit, which is forcing a little bit more of a conservative look in the market, because banks aren't having to compete as hard. The other thing, just with the higher interest rates, is that you've got a debt service challenge that you've got to solve as well. And so if you can't service the debt, you can't layer in as much debt, and so that's probably driving down some of that leverage level as well. So a couple things playing into that, and I don't know the exact answer, but I can tell you those different data points, and it's probably a combination of all those data points going into play. The other part that I say on this slide here, obviously if you got less debt, a lot of times these deals are having to be structured with a little bit more equity or some other creative financing that's outside of the senior lender level, just to get the deals done or have the deals be able to make sense. The other thing that we've noticed, slower velocity, but then the deals, I don't want to say getting extended, but maybe a little bit longer to close. They're not as rushed due diligence periods, or maybe a little bit more on both sides of the table. Both parties are holding different leverage cards to play, in the deal, I'd say. So, just maybe not important, but just something, that we've observed is that deals are sometimes taking a little bit longer to close currently.
Hey, Aaron, what are you seeing in terms of a typical timeline, what should people be thinking in terms of how long it's going to take to get the bank financing in place from, say, a letter of intent on?
Yeah, so that's a great question. And so what I'd say is, if you're, what a bank can do is a lot different than maybe what a bank will do. And so if you're coming to the bank and you're saying, hey, we need to close in 2 weeks, like, okay, that's physically possible, but that's going to raise a whole lot of red flags. Because why are you coming to us at the end? Like, what happened? What fell through? We're obviously not your first avenue. So that doesn't make sense. So a timeline, if we were your banking partner and you were examining potential targets, and you put an offer out there, and then you progress into your due diligence period, and if that's 60 days or 90 days or 120 days, we want to be along for that ride, because as we're asking our own due diligence questions, if you don't have the answer, you're going to want to turn and make sure you uncover that. So a typical timeline, I would say, just on the banking side, obviously, the company can control their own timeline, but ours, if you say, hey, we have this interest, we can turn around a term sheet or indication of interest, and optimistically, I'll say a week. Realistically, probably 2 weeks is where we're looking at that. Some negotiation there if you don't like the terms, and then we'll press. Once you say go forward from there, if you say, okay, Atlantic Union, you're the one, you're the horse that we're going to ride to close this deal. I say like a month is a good target. But that's so dependent on the due diligence schedule and what you're getting from the target company as well. So if all of that, if there's a data room and all that's built out and all the information's already there, then that works really well. But if it's a smaller deal and somebody's got to create that, or there's no quality of earnings that's been done or anything like that, or if there's anything that needs valuations or appraisals, that's going to extend that timeline. So it's very dependent. I think the big takeaway, and that was a little bit of a long-winded answer, but the big takeaway is that the bank wants to be there for the journey, so to speak. If you're calling us in at the end, that's fine, but there's going to be some more questions about maybe why we're late to the party. And obviously, if you got a few banks competing, that's completely fine, and often what we see. But if you're pulling them in late, it's going to raise more questions. Does that answer your question, David?
Yeah, no, that's great. As a matter of fact, one of the things that you just said is something that we preach at Capstone, and that is we actually want to bring the banks in before we even start looking at targets and prospect companies. Because we want the banks to have an appreciation, as you use the word journey. Why are we doing this? So that and what's the process that we're going through, and so that you have time to kind of get a sense for the market and the things that we're looking at, and can be, I think, a good partner throughout the process and kind of help as we keep our banking partners updated.
Yeah, absolutely. And I mean, I like to think that we add some value outside of just obviously the monetary aspect, just from our perspective, or giving you some ideas or considerations or thoughts. Obviously, David, your team's doing that as well, but we can have some pretty good ideas or thoughts or considerations as well. And then if it's a new relationship to us, I mean, there's definitely a ton of value in our ability to get to know the management team. That's a really important aspect of the deal for sure.
Yeah. I always tell people, our clients, let's bring the banks in early and get the benefit of that, so we're not scrambling at the last minute. And I think you kind of agree with that, and also the kind of the timeline. I think people should probably be prepared that it's going to take 60 days, maybe even 90 days, depending on the complexity and the level of data that's available.
Yeah, absolutely. Pressing on a little bit here. So whenever we're doing a deal, I always try to put myself in my client's shoes, or their perspective, and like you said, David, why does this deal make sense for them? What are they trying to achieve? What are their strategic objectives? So I always try to put myself in that perspective, or get that perspective to really understand a lot about the deal or the mindset. So for this presentation, I thought as I talk about what a bank's going to look at, it'd be good to put yourself in the bank's shoes and to understand that perspective. And so when you're talking about the senior lender, you're talking about the party that's going to have the lowest return, and so therefore it's got to be the lowest amount of risk as well. So I say 2% frame of mind. That's thinking, above the risk-free rate, the bank spread is going to be, call it somewhere in the 150 to 350 basis point, so 2%. And so just consider, like, what amount of risk would you take on for a 2% above the risk-free kind of return? And that's probably pretty limited. And so there's times where people say, oh, the bank's very conservative, or why are they structuring this, and they don't need that. Well, just think of it in that context. It's a pretty low return, so we're going to have the lowest risk. We're going to be the most secure, obviously, but that's kind of the thought process behind the senior lender. And so, if there's ever questions of why does the bank need this, a lot of times it's that going back to the risk reward spectrum there. The next thing I say there, so primary source of repayment. So for us, that's always going to be, we're always looking at operating companies, so that's always going to be cash flow from operations. It's just always going to be our primary source of repayment. And if it's not, then I drop you down to the bottom there and say, hey, let's look at maybe some different avenues. But for an operating company, there's got to be cash flow. If there's no cash flow, we're not going to do the deal. And so then once you examine that cash flow, you're going to look at, okay, how much debt can we service, or can they service the debt? If we're going to layer in some debt, can that debt be serviced? Can they make the interest payments? Can they make the principal payments? More importantly, we're aligned with the company that if the company does well, that's our best case scenario. So we are very invested and very interested in the companies doing well. So we don't want to layer on debt that's going to inhibit their ability to do that. And so we're going to use the fixed charge coverage, which is going to layer in all those fixed charges that the company is going to have to take on to operate. And so it's a little bit of a different look than just a pure debt service coverage look. And I'll jump into some covenants here in a little bit, but just a point there. The big one there, cash flow leverage, that's the one that's common that everybody looks at. The funded debt to EBITDA, look. So, obviously that's going to be, we're going to have parameters that we're going to look at for that. Obviously, it doesn't matter what that leverage profile is if you can't service the debt. So kind of a combination. But David, you were actually talking about bringing the bank in early. Something we like to do is just a debt capacity analysis. And the quickest way to do that is just basically working through a sensitivity analysis using funded debt to EBITDA. And I've got a quick example that I'll pull up later, but yeah, obviously that's going to drive a lot of the conversation. The next one there is secondary source repayment. So we got the cash flow, primary source. This is where the bank's going to be as comfortable as possible. So we're looking for a secondary source. So, is there collateral? What's our collateral coverage? And as these companies get of enough scale, 10 million EBITDA or 100 million revenue, once there's some scale there, we can look to start doing enterprise value deals. And so, that gives us more flexibility where we're just looking at that. But for smaller, lower middle market stuff, we're going to look for collateral coverage. So airballs are obviously pretty common when there's an acquisition. A lot of times you'll see banks that aren't going to play there. We are, every deal is different, so I'll never say across the board, but in general, we'll get comfortable with an airball, and that's where we're going to land up outside of a collateral base. So that's the airball. There's no collateral coverage, and we're lending above that. That said, we're going to want to have a clear pathway back inside the asset base in a reasonably short amount of time. What's reasonably short? I'd say that 18 to 24 months. That doesn't mean the term of the loan has to be that, but it means we want to work ourselves back inside of that, within that. Again, every deal is different, and if we're doing an enterprise value deal, less important. If it's a smaller deal, obviously that's more important, and that's going to drive some of the conversation. So on that same thing, then balance sheet leverage. So debt to equity, obviously, again, every deal specific. If we have an operating company and they're acquiring another one, and our operating company right now is very strong, you know, we're going to get more aggressive. If it's a pure acquisition, we're going to want to see some more equity. So very dependent there, but something we definitely look at. The next one, facility. So a lot of times people just think of, you know, having this as a term loan. A lot of times it could be a combination of things. So maybe there's a line of credit that's coming in, or an unfunded revolver, or maybe we want to put some on a line, or maybe there is an acquisition line. So it all depends on so many things. So obviously you've got the term loan, and that can change in duration. And I'll get into some of those in a little bit, but you also have lines of credit that you can use, or if somebody's going through an acquisition cycle, you know, maybe we put an acquisition line, and then we schedule and term some of that out as they happen. So there's a lot of different strategies and plays beyond just a standard kind of term loan or something like that. Another piece is you can break that up, and we might drive some of that conversation to keep ourselves comfortable, or just to be able to be more aggressive. And if there's an equipment component, maybe we can do some of that as an equipment finance loan. So there's a lot of different avenues. And again, to David's point, that's why we like to be in there early, so we can examine that and try to think a little bit more creatively of how we can help be as helpful and supportive as possible. David, do you see some of those different options and pretty often?
Yeah, no, absolutely. And frankly, some of the covenants can be disaggregated as well, right? You brought up, you know, equipment. So if it's an asset-based loan, that's a lot different than a cash flow loan. And for businesses that maybe have kind of disparate things, or maybe you're buying a business that has a different profile than what you currently have, we definitely see that as part of it. And I'm not speaking for your business, but one of the things that we see also is the structure and the terms, you know, maybe a little bit different. And, you know, maybe you can just expand upon that a little bit from your perspective. You know, aside from the financial metrics, what are some of the other deal attributes that, you know, from owners' perspectives, that what can they do that can help get an acquisition financed from a banker's perspective?
Yeah, well, so great question. I mean, you mentioned it earlier. If you're bringing the bank in early and we can develop that relationship and we can understand, that's a key part. And really the management of the company, yeah, I guess taking a step back, if the financial metrics if it just doesn't work, it's not going to get done. But what can help, and what can help the bank get more aggressive, is the management. And so if we're comfortable with the management, if there's quality reporting, if there's professionals in there, and it's not, you know, back of the napkin scribbled stuff, you know, that really helps us get comfortable. The reaction time, if we have an ask and it goes unanswered, or if there's a pretty fair turnaround in the response, you know, all that stuff, I would call it the intangibles, that really adds into, you know, how we can get the deal done. So we want to make sure, beyond the financials, we want to be comfortable. And if we feel like there's somebody with both hands on the wheel at the company, we're going to feel a lot more comfortable than if it's disjointed and, you know, nobody knows who has the answer, or we can't even get answers back. So just the quality of projections, reporting, the responsiveness, all those things really add in. And then obviously, you know, if there's experience in doing some of these deals, if they're, you know, if they've done some M&A, some acquisitions in the past, you know, that obviously helps us get comfortable as well. And seeing folks like you in there as well, or, you know, if there's, you know, the lawyers, the CPAs, you know, those folks, if there's a team around it, all that just kind of adds to the deal. Does that answer your question?
Yeah, and we actually just had another follow-up question that came in. How do you, and I think I know the answer to this question, but what are your thoughts about parent guarantees? You know, parent company guarantees. How do you see that?
Yeah, so yeah, great question. And so that's, you know, one of the bullets down there at the bottom. So a couple things. So depends what the acquisition is. If it's a, you know, if this, and I know I don't think a lot of your folks, this is private equity, but so non-sponsored, but in the sense of, you know, platform versus tuck-in or something like that. But in general, if if there's an acquisition, it's going to be a subsidiary or standalone, or depending on the health of that, yeah, we will look for the corporate guarantor to kind of support that, especially if it's somebody we're comfortable with or there's a lot of strength there. Definitely part of the conversation. Now, maybe it doesn't have to be, and we can maybe get around that. But a lot of times, you know, who we're most comfortable with, or that's if it's going to add strength, we'll probably look for it as well. The other thing, just to mention, go ahead. No, I was just going to mention, just so you know, somebody doesn't come back to me in 6 months. At the smaller end, you know, lower middle market, if you're talking, you know, less than 50 million in revenues, things like that, you know, personal guarantees will come into the conversation at that point as well. So once it's upscale and, you know, you've got a few million in EBITDA that's consistent and you're, you know, over 50 million and you know, at that point, that leaves the conversation. Obviously, no private equity deals. We're not doing any personal guarantees there. But if you're talking really smaller end stuff, you know, that'll probably be, you know, in our proposal. Maybe we can exception and gets negotiated out. But we're definitely going to ask for it for sure at the lower end. But yeah, once it's upscale, obviously, you know, then maybe the corporate guarantor becomes more important, or we look to that.
So you obviously have hit a vein because we got some more questions that have come in.
Yeah, that usually does. That usually does.
I'm not surprised. This kind of gets to the heart of getting deals done, as you and I both know. Two questions. One is about using external valuations. How do you guys generally do valuations on your own? Do you look for an external third party to do some kind of valuation? Talk a little bit about valuations. And then I'll come to the next question.
Yeah, great question. And I'll say it depends. In general, you know, we'll want the third party. So with quality of our QOV, we're going to want, you know, somebody third party that's doing that to kind of provide an additional, you know, validation of numbers. For actual valuations, if we're doing equipment or if there's something, you know, specialized in there, you know, we have our equipment finance partners internally, depending on this is where I say it depends. Depending on the equipment, sometimes we can leverage them if we don't need to actually do a valuation on the equipment or something like that. In general, though, if it's more specialized or if the deal is really relying on that support, then we're going to definitely get a third party, you know, outside provider to provide that. It just, you know, gives us more comfort, makes it more tangible, especially, you know, the reliance on, the more we rely on something, the more we want to make sure it's accurate.
So the QOV, quality of earnings, you're using that a little bit more than just doing an independent company valuation, it sounds like, if I heard you correctly.
Correct. Yep. Yeah. So, and sometimes that, it depends on the target. So if the target's, you know, of scale and they have full audits done and they have good reporting and you know, that, you know, maybe we can get around that. And if we're using the acquiring company and they're providing all the strength and we're basically just doing the deal on their strength, you know, then it doesn't so much matter. But if we're looking at, you know, more relying on pro forma EBITDA and, you know, we layer these companies together and what that looks like, then yeah, we want to make sure there's accuracy in the reporting for sure and the quality of earnings.
So that actually was a nice lead into the second question that came in, or the next question that came in. That's around audits. How helpful is it to have audited financial statements?
Yeah, and it probably doesn't say in the question, but are you for the acquirer or the target?
For both. I guess I would say both. But in particular, I think for the well, I think both. Let me leave it at both, and then I'll kind of give you. But I think the question was more from the buyer's perspective. You know, the person that you're banking, so the buyer of a company. But if you separate those out, how do you feel about audit? Well, actually, maybe let's just focus on the target for a minute, because let's assume it's somebody that you have a banking relationship with. How do you value a audited financial statements on a target that you're looking to finance for the buyer?
Yeah, and so back to the comment earlier about reporting quality. So an audit is it's gonna make us the most comfortable, and so if we have an audit, that's fantastic, and that's the best case scenario. And so I kind of asked the question, who were you looking at? Because an audit takes a lot of time, and so based on what the due diligence period is, theoretically, if that maybe that company was for sale, or maybe, David, you introduced them and they weren't even for sale. And in that scenario, maybe they haven't done any preparation to sell. And so at that point, getting an audit, maybe that extends it, and maybe it's not possible from a timing. Obviously, an audit costs more money. From a banking perspective, yeah, we absolutely, if we have an audit, that's best case scenario. But deal size, if it's a really small, if the acquisition's a small, more tuck-in, and it's not, only has $1 million or $2 million in EBITDA or something like that, then that's maybe where the QOB comes in and support. Maybe they have reviewed CPA reviewed statements, and then we have the QOB, and we can kind of put that together, and the acquiring company does have an audit. So for us, we're gonna, based on how much we have extended, that's where we'll start dictating, hey, we've got to have an audit. That'll really drive it on our front. But if you just ask me the question, what's the reporting that's going to make me the most comfortable, it's always going to be the audit.
So when we're representing sellers, that's one of the first things we recommend. If you don't have audit financial statements, get them. My experience is they'll pay for themselves. People don't like them, but from my experience, it's going to make it a lot easier to get the financing, to get people. It's not just you, it's the bank, but it's also the buyer. So if you're from a seller's perspective, I think it's well worth the investment of time and money if you're serious about it and you're big enough. I think it makes a lot of sense. Hey, before we get too far along, let's take this opportunity to do our second poll question. What's a question you want to ask, Aaron? Do you want to what do you want to ask the audience for their poll question? Do you have a good one?
Well, the first one was what about inflation? So
I asked inflation. Is it gonna stay the same, or is it gonna get lower? So what do you want to talk about?
So I think I was going to ask something about interest rates, right? But I think that's almost in tandem with inflation. If inflation is going to go down, then I think interest. Well, yeah, you can still ask that. Are interest rates gonna? Are interest rates gonna? Is it a multiple choice? Can they say up, down, or stay the same within, say, the next?
Yeah. Up, down, or stay the same. Three options. Interest rates. I like that. So let's go to, for those of you that are on the CPE track, go to the question box and just answer, do you think interest rates are going to go up, down, or remain about the same? And most people, by the way, just looking quickly at it, Aaron, most people suggested that the inflation is going to be flat to lower.
Yeah.
So most people seem to think that we've gotten a handle on that.
So then I would expect that you'll see the results for the interest rate to either, stay the same or start going down. Just if that's the sentiment for inflation, I would expect rates to match that.
Yeah. So. You guys don't mind if they stay up a little bit longer.
Right. Yep. Yeah. I mean, yeah, just some stability too, I think helps, right? And that's where once people get comfortable, they come off the sidelines a little bit too. So, okay, yeah, just wrapping up this slide though, I talked about we talked about the guarantees, we talked about the timelines. As far as, yes, we are seeing sellers maybe get some more opportunities to roll some equity. My only comment from the banking side, and we have the seller note, so anything besides us, we're gonna have to have. It's gonna have to be subordinated. So if there's a seller note, it's gonna have to be subordinated, and so maybe we can work in, based on covenants being met, obviously interest, the service of that, maybe some principal as well, but it's gonna have to be subordinated. And then back to the term, anything that's alongside of us, we're gonna have to. Our term is gonna be inside of that. So you can't. We wouldn't do a deal where there was a seller note for 2 years and we're at 5 years. Our note's going to have to come up first. So just a comment on that. And then I also say other options. I'm not going to talk about it. I'm not the guy to talk about it, but At the very low end, obviously you've got SBA options. David, you touched about ABL. You know, that could be a great asset or a great avenue for some folks that works really well. And then I think private capital, depending on where rates go, I think, you know, that comes back into play. It is in play. But I think just in the rate environment right now, people can sit on the sidelines and have a decent return. And I think as people maybe look for yield, you know, some of this comes back into play. So just the comments on that. But yeah, the takeaway, senior lender is going to be most secure. Anything aside of us is going to have to be subordinated.
Quick question on that, Aaron. How often do you see personal guarantees in your transactions?
So that goes back to the size of the companies and the size of the deal. So again, if it's, say, you know, less than 3 million in EBITDA, if it's less than 50 million in revenue, we're gonna be asking for the personal guarantee, and we're gonna have it probably, you know, 85% of the time. Once you get above that kind of $50 million hurdle, you know, we're not going to ask for it, because usually there's some history and some strength in the company, and there's you know, stability as well. So that's where I say at the low end of the market, we're definitely asked for it. But once you get kind of some scale and size, then, you know, we're not going to ask for it, and the company's kind of proven itself already.
Awesome, thanks.
Yeah. We talked about the covenants there, but yeah, the common ones, there's so many different variations, and you can always tweak these. You can always agree or negotiate. Maybe we're adding back some certain things, or maybe we're, you know, not counting something. But in general, there's always going to be, or we're going to look at, even if we don't have it as a covenant, but usually it's going to be a fixed charge coverage, kind of to give us that debt service look and the ability to cover necessary costs, and then the cash flow leverage. So those will be kind of the two main ones we look at. You know, I say minimum tangible net worth as well. If there is not comfort around distributions or something like that, or we want to make sure that this is building in net worth, you know, we can. That's another one that we'll look at. But you know, really those top two are going to drive it, and you can tweak those. So, you know, with acquisition, maybe there's a little bit of a higher leverage profile, and we look to step that down over a couple of years. But in general, that's what we're looking at. We talked about financial reporting. You know, just in the interest of time, kind of glaze over that. But the one I do want to touch on is people so often focus on the financial covenants. I don't want to say more often than not, but a lot of times where we see a lot of the negotiation is actually in the negative covenants, where there's some prohibition against certain things. You know, I'd say change of ownership, management, you know, additional acquisitions, other loans, liens, investments. So, you know, I just say here, that's protecting the bank, and it's really, we may be the most vested party into this deal. And so really, it's just giving us the opportunity to raise our hand if there's a material change in the company, to raise our hand and say, hey, we want to look at that, or we want to at least have the right to have a say in that. So that's my comment on that. Due diligence, we talked about this, but yeah, this isn't an inclusive list, but we're gonna want obviously all the financial reporting, you know, based on the structure of the deal, you know, what we talked about, the valuations, we talked about all that, projections for a legacy company, but then put together pro forma as well. We'll want to review all the, you know, purchase agreement, if there's leases, legal filings. We'll look at, you know, any liens, anything that's out there, obviously. But most importantly, we got to understand the ownership. We got to understand the capital structure. We got to understand the sources of uses. All that stuff's very important, and not just, we got to understand it beyond just see it. So we certainly have some questions on that, just to make sure we've got all that under control. Obviously, all the standard KYC stuff, you know, anything that you're going to get through the regulatory environment. You know, real quick, this is just illustrative. This is looking at, you know, basically using funded debt to EBITDA. So if you're thinking about doing acquisitions, you can basically just do the sensitivity analysis. And if I know I have, in this example here, I'm an $8 million EBITDA company, maybe I've got 10 million in debt currently, and I want to stay below 3.5 times, what's my debt capacity? Okay, here we go. Or If I want to keep it below 3 times, here you go. And it's just, I mean, it's just easy equation, but you can just see. And again, as you're maybe early stage, it can be helpful to sit down, because that can maybe craft who your targets are as well. But then the other side of that is, if you're layering on, if you've got some EBITDA that you're acquiring, that can expand those means. So important to note, that's just one lens to look at. And so that's not to say that you did the debt capacity, off the funded debt to EBITDA, that's what the bank's going to lend, but it can be helpful to initiate some conversations. Obviously, all that other stuff we talked about, it's going to come into play as well. So path forward, I just say, I don't have the crystal ball. We joked about that earlier. We joked about how 12 months ago we thought the economy was in the tank or going down, and we were going to be in a recession by the summer. That didn't happen. And so a lot of these predictions are often wrong. I don't see anything that's seriously broken. There is some uncertainty out there for sure. It's not completely sunny skies, but nothing seriously broken. So I generally remain positive. I think we've had for a couple years now, and I think we most felt it last year, is a little bit of a reversion to the mean and just markets normalizing. There was such a huge shakeup around COVID with supply chains and infusion of money and everything else, that it's just taken some time to normalize. Now you had inflation, so now you've got all these higher interest rates. So you've got people sitting on the sidelines doing okay, just basically sitting on the sidelines. That won't last forever, but I think really more than anything, that's driven some uncertainty, but it's just normalization is kind of how I see it. So.
Do you see any drivers for M&A activity coming up in the next 12 months?
Yeah, so I think all of the stuff we talked about. So, where does inflation go, and subsequently, where do rates go on the banking side specifically? So that if there is increased capital requirements, that regulatory environment, if that increases, I think that's why you've seen, I think some banks have used the uncertain economic backdrop almost as an excuse. I think really there's some capital sitting on the sidelines because there's some uncertainty of what those capital requirements are going to be for banks. Now that's mostly at this point seems to be at the 100 billion and over level. So some of those larger players, thankfully we play below that. But I think that's where you're seeing some of the credit rationing from some of those larger players. I think that all adds into it. So I think once that sorts itself out, once there's more certainty of where the direction of the economy, I think that's my thought process. I'd be really interested or curious to hear your thoughts there, David.
So I think there's a couple things that we're seeing. One is there is a level of hesitation. You mentioned, I think, a very interesting point early on in the conversation. That is that valuations haven't dropped. And normally you would expect valuations to drop, but I think what we're seeing is that there's a return to quality where people are not going out and just buying deals or buying companies to just do deals. They're buying companies that make sense, that are very strategic, that play a role. And those companies, by and large, I think are also companies that would be in demand. So they're quality companies. So I think a lot of I'll just use the example of dogs and cats, or that euphemism is, I think that's been cleaned out a little bit and flushed out a little bit in the marketplace. And to your point, we're kind of going back to the mean. We're back to kind of normal levels, maybe a little bit low, but kind of more normal levels. I think the other part is people are having to get used to the fact that, okay, so, what's a typical interest rate that people should expect, Aaron, when they're putting together their pro formas? What's a typical, let's say they're an $80 million revenue company. They're buying a $10 million revenue company that's got $3 million of EBITDA. So it's a highly profitable business. And they want to finance up to 3 times EBITDA. So what is that, $9 million? What kind of terms should they expect, and what kind of rates in today's environment, knowing that it's going to fluctuate, but what's kind of the range or the ballpark that's in the current market today in terms of length of the loan and the interest rate?
Yeah, so great question. I'm going to go all the way back here to this first graph. And so what I'd say is that's the interesting thing about where these rates are, is that for that company, they're going to pay more on their line of credit right now than they would on a extended term note or something like that. So if they're they just have a silver plus, 250. They're, over 7%. We're not quite to 8%, but you're getting up there. Whereas if you're and actually just in the last few weeks, there's been a lot of downward pressure on these treasuries. So you've seen, the 5-year and stuff recently, start to come back down. And actually, in October, the yield curve, the 2 and 10 actually got real close together. Then we had the inflation read, and they split back apart. But that right now, it's gonna be cheaper for that company to have a 5-year term than to just have that revolving on a line. And a month ago, that 5-year, plus bank spread, you would still be over 7, but you wouldn't be pushing 8. Whereas now you're closer to 6.5. So again, I really hesitate to say numbers just because every deal is different, and I don't want to say something and then we price it and we've got to put it into our return metrics and everything. But generally right now, based on the rate environment, you're doing better with a 5 or 10-year term than a 2-year or on your revolver. Now, for an acquisition that you just said, we're probably not doing a 10-year. It depends on the company, industry, what assets do they have? Again, we're going to want to be, if those assets, if it's technology or something that doesn't have that stronger life, then the term's going to be shorter as well. So we'll pair it to that a little bit. Whereas if it's equipment that's got a long life, we can extend it a little bit. Those are the thoughts on that. Does that answer?
Just give a little bit of a sense, and I think what we're seeing is now people are having to figure out, just like buying homes, right? So it's not that you're not going to buy a home. I mean, people don't need to buy a home, but people still die and get divorced and move or get transferred or want to downsize, or same thing with companies, right? They're not going. And 7% may sound like a lot to people, but those of us that have been doing this for a while have paid more. And if you're able to grow it better than that, and that's why I just try to encourage people, put in your model, put in a 5 or 7-year term, put it in there at 7 or 8%, just to get a sense for what's the sensitivity of that. Can you make that money back based upon the acquisition? And is there enough of a cushion so that you're not running right on the margin? So if you think you're going to be able to get it through synergies of cost savings or being able to grow the business, that's pretty cheap money. At the end of the day, that's pretty cheap money if it's going to allow you to propel that growth. And that's just the part I'm trying to help people to understand and kind of readjust. And that's where I think people are now getting it and having had more time to think about it, because otherwise, what's the alternative?
Yeah, I think if you look at the overall kind of cost of capital now, I think you're, a little bit higher. That's where the senior lender, that's why the value we provide, we're going to be the lowest provider of capital, lowest cost provider of capital. But to your point, it's all about, I don't want to say arbitrage, but again, if let's say even that cost of capital is 10%, but if you can return 20% on that, like that's a good deal. So, or more than that. So it's a good point.
Another question that came in, and then we'll do our last poll question. What's the percentage threshold to be on the personal guarantee list?
Percentage threshold. So
ownership. So what percent ownership? This came up during you recall this came up during the PPP loan thing. It kind of highlighted for folks. There were some private equity people that got caught a little off guard because they realized all of a sudden that now they were on the wrong end of equity. They thought they wanted all that equity, but it didn't work out well because they couldn't get PPP loans. So the question came up: what percent ownership puts you on the private guarantee or personal guarantee list?
Yep. And so a little bit deal specific. So obviously, best case scenario, we've got, and it depends on, so that's why I said that it's so important for us to understand the ownership structure. And so if there's 25 owners in there and it's almost got a different feel, like that's going to be different than if there's 3 owners and it's 60, 20, 20. At that point, we 20, so we'll say kind of 20% is a good kind of target level. We definitely want the majority owner, but if it's 60, 20, 20, we'll ask for all. And honestly, if I was the guy that owned 60%, I wouldn't want to personally guarantee everything if everybody else wasn't going in. And so you can do it pro rata as well. So there's certain ways to carve that. So we can get a little creative to do that, but anybody that's a material owner, and again, this is the lower middle market, that's where we're asking for it, that's what we would ask for.
I also tell people, you want to get the guarantee from the one that has money.
Yeah, exactly. So and sometimes it's all about getting the strength, like where's the support to get the deal done? And so, maybe it's a silent investor, but he's got the strength and he's willing to personally guarantee it, and that's not impactful for him. Well,
Right.
Fantastic. That gives us the comfort it gets the deal done. So let's do it. So great point.
Before we do our last poll question, let me give you a minute to just say a little bit about Atlantic Union Bank. I just gave a quick highlight, but say a little bit more and how people can get in touch with you if they want to follow up.
Yeah, absolutely. So, here, just a little quick map of the bank, but yeah, David hit on it at the top. So we pride ourselves in our coverage, our delivery, our experience, really that I say big bank capabilities without the big bank headaches. And so 20 billion asset bank, we're actually doing our own acquisition now, so it'll be 24 billion, hopefully, early next year. But you can see our footprint there, and it's really pride ourselves in the delivery to the market and our experience and our ability to be agile and respond. So yeah, it's a fantastic bank. As far as reaching out to me, obviously, if you reach out to David, he can certainly steer you my way. If you want to take a quick snapshot of the screen, there's my contact information back up there. But again, David, really appreciate the opportunity to join you today. And I think it'll be it was an exciting year this year. I think it'll be an exciting year next year. I would say don't listen to all the doom and gloom. There's certainly some sun there. You just got to find it.
I keep telling people turn the news off. Aaron, a pleasure. Let me get our last poll question in so we make sure we're compliant for CPE. So for those of you that are in for CPE credit, what do you think next year, 2024, is going to be like for the M&A market? Is it going to be up? Is it going to be down? Is it going to be about the same as 2023? So M&A activity for the U.S. for 2024, up, down, or about the same? And also, I think there'll be probably a survey coming out at the end of this, so we encourage people to give feedback. That's part of the reason why we're having this conversation today with this special webinar, because people said, hey, we'd like to know more about what's going on in the banking world, because people got caught a little bit shorthanded and a little bit flat-footed, and didn't. I think they got spooked, and so part of it's about getting people to be informed. And Aaron, you did an outstanding job of helping people to get a better understanding of what can be a pretty complex. Not everybody gets all those terminologies, and they don't do it every day. But you did an excellent job of giving people that level of comfort, and so thank you. We're grateful that you were able to take time out to join us today.
Yeah, if there's any follow-on questions, certainly happy to shoot them over. Certainly happy to answer those.
Excellent. So again, Aaron Metrick, Atlantic Union Bank. Everybody stay safe, and we'll see you at our next webinar. I think it's next week. We're going to have our year-end webinar as well for our regular M&AU. But again, thanks everyone. Be safe, and we'll look forward to seeing you next time. Take care.